For times in the last 100 years, a bull market has ended the same way. 1929, 1999, 2007, 2021. 4 different decades. 4 different engines. 4 endings that rhyme. This isn't a forecast. It's an archive. Chapter 1. The Pattern. Before we get to the cases, a quick note on what we're actually looking for. We're not looking for a price target. We're looking for a shape. Every major market peak in the last century has shared 4 features: parabolic price, narrative certainty, retail participation, and a final melt-up. When all 4 appear together, history says pay attention. Chapter 2. 1929. From 1921 to 1929, the Dow rose almost 500%. The last 18 months were the steepest climb of the entire run. 500%. In 8 years. Margin debt hit levels never seen before. The country's new middle class was invested, often for the first time. Days before the crash, the economist Irving Fisher told America the market had reached, quote, a permanently high plateau. Then September. Then October. Then the pattern finished itself. Chapter 3. 1999. 70 years later, a different engine, and the same shape. The Nasdaq rose more than 400% in 4 years. 400%. In 4 years. The day trader became a demographic. Books were written about them. The narrative was simple again. A new economy. The internet changed everything. The top arrived in March 2000. The decline ran for 2.5 years, and took the index down 78%. Chapter 4. 2007. This time the engine was leverage, not narrative. Housing had never fallen nationally in modern American history. That was the thesis, and structured credit packaged that thesis into instruments the whole world could buy. Into the peak, volatility was low and spreads were tight. Every top looks calm from inside it. What came next we now call the global financial crisis. Chapter 5. 2021. The most recent case. Close enough to feel current. The engine this time was pandemic stimulus and zero interest rates. More than 10 million new retail accounts. Participation at levels not seen since 1929. The narrative again, the old rules no longer apply. Said with different words every cycle? Always said at the top. Chapter 6. What all 4 share. Put the charts side by side and the shape is unmistakable. A long patient climb, a steep final year, widening participation, skeptics mocked, and narrative certainty. The newest buyers take the most risk at the highest prices. Every time. Not because they are foolish, because they arrived late. Chapter 7. What came after? Historically, the drawdowns from these peaks have been deep and slow. 25 years to prior high after 29. 15 after 2000. Roughly 6 after 2007. None of that is a prediction. It is only what the record shows. Chapter 8. Why the pattern repeats. Markets are not cyclical because prices want to be. They are cyclical because memory is short. Roughly every 20 to 30 years, the last people who remember the last top finish retiring. New hands build the next parabola. The generation that didn't live through the last drawdown quietly repeats the behavior that caused it. Chapter 9. What patient observers did. In every case there were investors who watched the melt up without joining it. Not because they were smarter, because they had rules. A fixed allocation. A rebalancing schedule. A pre-committed response to euphoria. They missed the last 15% of every run. They also missed the first 50% of every drawdown. Rules don't predict tops. They make predictions unnecessary. Chapter 10. What this tells us. The honest answer is, we don't know where we are in the pattern. The pattern only becomes visible after it completes. But history is a record. And 4 times in the last 100 years, bull markets have ended in the same shape. 4 endings. 1 shape. What you do with the archive is your decision, not this channel's. If this was useful, the next episode looks at what happened the last 4 times yields did what they're doing now. Same rules. No predictions. Just archive.